Bitcoin and crypto investors are staring at three massive shifts this week. The Fed's first rate cut of the cycle, Japan's debt time bomb shaking global markets, and regulators in the UK and US finally softening their stance on crypto. And to that, new blockchain plays like Amex and quantum resistant platforms, and the signal is clear. Macro and tokenization are converging fast. Let's break it all down, what matters and what to watch. Well, this is actually hot off the press. On September 17th, the US Federal Reserve has cut its benchmark interest rate by 25 basis points, marking its first reduction of the year. Now, this formal policy shifts that the Fed views labour market risks as now outweighing inflation pressures, which opens the door now for looser monetary conditions. Market reactions such as these, rate-sensitive sectors, whether it's in credit and consumer finance, the tone from the Fed officials about future cuts in upcoming meetings, and how this cut feeds into liquidity expectations for Bitcoin and real-world assets. Now, as I said, we need to pay a close eye whenever that we have these kind of very positive announcements around lowering interest rates, because whenever there is a cut in the fund rate, whether it's in the Fed or any other central bank, in the sense that is lowering the actual cost of borrowing of capital to invest in more high-graded investments like Bitcoin, crypto, and even high-graded equity stocks. So this is very good news, not just for the businesses or even for the mid-caps, but also for retail investors such as you and I. And like I said in the previous episodes, the train of thought is going to be more rate cuts, not just by the US Fed, but other central banks in leading economies at least. They're going to be expected to follow suit. And this ripple effect will pave the way more bullish sentiments on those Bitcoin and crypto leading assets. So let's look at this article where it says Japan debt implosion risk. A leading economist warns Japan's debt dynamics could actually spiral, undermining the yen and stressing global bond markets. So why it matters? Sovereign fragility in the world's third largest economy could accelerate capital flights into hedges like Bitcoin, similar to gold during currency stress. So what do we need to watch out for? Yen weakness and bond market instability, both potential catalysts for Bitcoin inflows as a hedge against fiat devaluation. Now, this is an interesting article because the UK has originally been trailing behind the US and other leading nations when it comes to the adoption of Bitcoin and crypto. So this seems to be a shift in policy, like a 180 U-turn from its original anti-crypto, anti-Bitcoin stance. This article highlights that the UK's financial regulator, the FCA, plans to relax restrictions on crypto firms, a sharp turn from its cautious stance. Why does this matter? Well, London is still a global financial hub. Easier crypto rules could indeed unlock institutional participation and fast-track real-world asset tokenization adoption into traditional markets. Whether the UK move triggers regulatory competition in Europe, and how quickly institutional players respond with new crypto products. So, as I said, the UK woken up to the fact that they need to raise their eyebrows and pay more attention into these growth industries like Bitcoin and the crypto industry. And it's good news because it's never too late, right, to actually get into the bandwagon. So this is very hopeful news for the UK residents in the country. Now, continuing on the theme of the UK, the US and UK are preparing a joint cooperation framework for crypto regulation. This would actually facilitate a harmonized approach to cross-Atlantic rules, would actually reduce regulatory fragmentation and lower the barriers for institutional adoption of Bitcoin and tokenized assets. So the opportunity here and what we need to watch out for in this space is the underlying specifics of the deal, particularly around custody, tax treatment, and stable real-world asset frameworks that could actually set the global standards. So very interesting times ahead. And like I said in the previous article, given the recent policy shift, it seems that they're going to be exhilarating in UK stance to crypto and Bitcoin. So very, very good news. And we need to watch out for, as I said before, the actual specifics of this deal in terms of its practicality on how they're going to create this cross-Atlantic rule set or level playing field for Bitcoin and crypto between the two countries. Right, now going on to a couple of RWA spotlight stories I'd like to bring your attention. It's still in its early days of adoption. So the first one is on Amex travel stamps. So American Express have launched a blockchain-based travel stamps, which is going to be based on a specific ERC721 NFTs token. So this is like the actual technical blueprint to create these NFT tokens, which is going to be for these travel stamps on the base network. This is actually going to be designed for users to collect and share their travel experiences. So that is the actual value proposition behind these American Express travel stamps. They are non-tradable and aimed at customer engagement, not speculation. It shows that even a top-tier legacy brand like Amex are experimenting with blockchain technology for loyalty and lifestyle use cases, proof that tokenization is entering mainstream consumer experiences. If it involves beyond novelty, it could set a precedent for how consumer finance brands adopt Web3. Now, this is very interesting because even though it's just in its early stages of real assets adoption, it just comes to show that even the likes of Amex and other legacy firms, whether it's Visa, MasterCard, which is its competitors, even the mainstream players, where they originally felt that blockchain technology was even a threat to their existing business models, they've quickly woken up to the fact that they need to get involved in some shape or form in blockchain technology, because it's like a drop in the ocean. Once the pebble's been dropped, you're going to start to see these ripple effects across the pond and eventually into further afield. It sets the precedent that this is going to continue its journey and the momentum is going to be picked up quite significantly in the future. So this leads to the final RWA spotlight story I'd like to share with you. We all heard the original threat around quantum computing on blockchain. Well, this is one player that actually is trying to come up with some innovative solutions, how it can counter that threat. So QANplatform is a layer 1 blockchain using quantum resistant cryptography, hybrid architecture, and EVM, which is Ethereum virtual machine compatibility. As quantum computer risk moves from theory to future reality, early quantum secure infrastructure offers potential defensive positioning for RWA investors. So what we need to watch out for here is the adoption metrics, such as developer activity, the dApp ecosystem, audit credibility. So if the blockchain has been audited by an outside auditing firm to ensure that there aren't any gaps and loopholes or even hacks in their blockchain offering, the QANX tokenomics, and even the enterprise regulator partnerships. So we're going to be seeing more solutions, more innovations happening in this space, and some brainstorming as to how we can come up with more quantum resistant blockchains to remove that threat that was originally prevalent in its day from the Willow trip from Google, where they made some claims that it was a threat to the likes of Bitcoin blockchain, which it really wasn't the case at the end of the day. I've made a couple of videos on that, which I would encourage you to subscribe to this channel to learn a little bit more as to why it wasn't a real threat at that moment in time. So we're going to be seeing, as I said before, many more solutions to enable even the legacy blockchains to become more quantum resistant in the future. So there's going to be an awful lot of activity happening in this space, and we need to keep a close eye on its progress. So here is the takeaway from this week's episode. Central banks can cut rates, but if bond yields don't move, liquidity won't flow as expected. Japan's debt risks remind us that sovereignty fragility is real, and Bitcoin is quietly positioning as the hedge. On the other side, real assets tokenizations are no longer theory. ETFs, regulatory shifts, and even quantum-resistant projects show how fast the rails are being built. It's this intersection where macro pressures meet tokenization that will define the next cycle. If you want the clarity without the hype on Bitcoin and real assets, then this is the desk you'll want to come back to every Friday. Subscribe, drop your thoughts below, and let's keep connecting the dots together. Until next time.